Dear colleagues at DC Fintech Week, my name is Drilona Emrullahu, and I'm a senior research analyst at the International Monetary Fund and a PhD candidate at the Université Catholique de Louvain. I'm excited to share insights from our research paper, which delves into the intriguing dynamics between fintech and traditional financial institutions. Over the past decade, we've witnessed remarkable growth in fintech transaction volumes worldwide, particularly in digital lending and digital capital raising activities. Despite the regulatory crackdown in China leading to some reduction, the volume of fintech finance has shown a secular upward trend. While the current volumes of fintech finance remain relatively modest, estimated at around 2% of the total credit in major fintech markets, there is a strong expectation of continued rapid growth. The emergence of fintech has delivered significant advantages for both traditional financial institutions and the wider financial system, such as improved efficiency in financial service delivery, increased competition, and enhanced access to finance. However, it can also pose challenges to incumbent institutions by eroding their market share and undercutting their profit margins. The question that we examine in our paper is, what is the impact on the traditional incumbents, such as banks and non-banks? In our paper, we test two main hypotheses: complementarity versus substitution hypothesis. The complementarity hypothesis argues that fintech activity complements and improves profitability of financial institutions. This could happen if incumbents partner with fintech firms to reach new customers or use new technologies to enhance their operations. Partnerships can take the form of mergers and acquisitions, as well as incumbents outsourcing specific parts of the transaction process, such as customer onboarding, verification, and credit scoring, while the originating bank handles the loan. Other partnership models could involve incumbents providing funding for fintech platforms in exchange for a fee, with the platform facilitating all elements of the transaction, including loan origination and payment servicing. Incumbents have also been making substantial investments in information technology to meet customer expectations and adapt to the growing presence of fintech firms in the market. This strategic approach enables incumbents to reduce operating costs and enhance overall efficiency. On the other hand, the substitution hypothesis argues that fintech pressure reduces the profitability of financial institutions. This could occur if fintech firms take business away from financial institutions by offering better rates or user experiences. Indeed, fintech firms excel in efficient screening of potential borrowers and processing loan applications at a faster pace compared to incumbents. Moreover, empirical evidence suggests that during periods of regulatory shocks, such as the implementation of higher capital requirements, traditional banks may reduce their lending activities. This reduction in lending can potentially drive customers towards fintech platforms, seeking alternative sources of financing. It is important to note that fintech firms, not being subjected to the same level of regulatory scrutiny as incumbents, have more flexibility in terms of the products they can offer and the target customers they can serve. These factors collectively present a significant challenge for incumbent financial institutions that must navigate through the evolving landscape of the financial industry and find ways to effectively compete with the disruptive forces of fintech. To achieve this, in our paper, we utilize a comprehensive cross-country database that encompasses around 10,000 financial institutions, including banks and non-banks, and data on digital finance, such as digital lending and digital capital raising activities across 57 countries. Our findings provide stronger support for the substitution effect. Specifically, increased fintech presence reduces bank profitability, driven primarily by lower net interest margins and higher costs. This effect is definitely noteworthy, considering that the average growth rate of fintech volumes during the period between 2012 and 2020, excluding China, reached 70%, indicating that a rapidly growing fintech competition can exert pressure on the income of financial institutions. While incumbent financial institutions have made efforts to diversify their income sources, our analysis indicates that these measures have not fully offset their losses incurred from fintech competition. Different fintech business models have varying impacts. Cooperative banks experience more significant profit deterioration under both models, whereas larger commercial banks appear to benefit from partnerships with P2P platforms, as evidenced by an increase in non-interest income. Furthermore, our analysis reveals that the relationship between fintech and the profitability of incumbent institutions varies depending on country-specific characteristics. Banks in countries with more competitive, profitable, and developed financial systems tend to suffer greater hit to profitability from fintech growth. Interestingly, and more importantly, however, traditional financial institutions in countries with stronger regulatory frameworks appear to benefit from the expanding influence of fintech firms. This implies that well-designed regulations can establish a level playing field, enabling new fintech companies to thrive while protecting incumbents from uneven competition practices. So what are the policy implications? Well, these findings underline the need for continuous monitoring of fintech's impact on the financial system. While it's brought efficiency and competition, it poses challenges, including market share erosion and profit margin constraints. Striking the right balance between promoting financial innovation and mitigating systemic risks becomes crucial for regulators. To achieve this balance, specific recommendations could be considered to broaden the regulatory scope and create a level playing field. These include reviewing and redesigning licensing regimes to encompass new types of service providers within the regulatory framework where appropriate, implementing more robust capital, liquidity, and operational risk management requirements that match the risks posed by different fintech business models, and strengthening the regulatory framework and supervision for smaller, less technologically advanced incumbents who may be more vulnerable to fintech competition. Traditional financial institutions can also adapt by enhancing cost efficiency, diversifying income sources, improving governance, and addressing problem loans. Additional strategies and measures may be necessary for traditional financial institutions to effectively navigate the evolving landscape and mitigate the overall impact on their profitability. In conclusion, as fintech continues to reshape the financial landscape, understanding its implications and taking proactive measures is key. Thank you.